Chapter 1. The Global Reserve Power Game. Imagine waking up one day and realizing your country's money can't buy fuel. Not because oil stopped flowing, but because you no longer have the one thing the seller demands: US dollars. That's not science fiction. It's reality for dozens of nations every single year. You see, over 80% of global trade still happens in US dollars. Not euros, not euros, not euros, not euros. If you're a country like India and you want to buy oil from the Middle East, you need dollars. If Brazil wants to import computer chips from Taiwan, it needs dollars. If Germany wants to settle a debt, it doesn't send euros. It sends dollars. There are only two things almost every country in the world will accept without a second thought: gold or dollars. And between the two, dollars are easier to store, trade, and move. This is why countries hoard dollars like survivalists hoard canned food. But it doesn't. They buy US government bonds, they lend their dollars back to the United States, and in return get something the world still calls the safest asset on earth. That asset is the US Treasury bond. Why? Because America controls the world's printing press. If the US owes you money, it can print more dollars and pay you back instantly. Try that in Argentina or Turkey. Now here's where it gets interesting. When a country earns billions in exports, it usually faces a problem. If it keeps too many dollars at home, its own currency rises in value. That might sound like a good thing, but it's actually dangerous. A stronger currency means their products become more expensive to foreign buyers. When goods become too expensive, sales collapse. Factories close. Jobs disappear. Growth stops. Ask Japan what happened after 1985. So what do countries do? They recycle those dollars. They hide them in their central banks like squirrels hiding nuts for winter. This is the invisible circuit of global finance. Dollars flow out of America when it imports goods. Then those same dollars boomerang back when countries invest in US debt, and the circle continues. Now think about this. Over $10 trillion in global reserves are stored in US dollars. That's not a guess. That's a fact. But almost none of that is sitting in vaults as paper. It's in treasury bonds. When you hear foreign countries are funding America, this is what it means. They lend America money. America prints more money. Then it pays them back, using the money it just printed. It's like borrowing your own checkbook and still being called trustworthy. And yet it works. Because no one wants the system to break. If it does, the collapse is not just American, it's global. Your currency depends on the value of the dollar. Your savings depend on assets priced in dollars. And that's the truth most people never hear. The dollar isn't strong because it's flawless. It's strong because it's everywhere. And if it fails, everything else fails faster. But here's the twist. Even as the dollar dominates, its value has been slowly melting for decades. The money you hold loses power every year. And still, everyone keeps buying more US bonds. Why would anyone invest in something that loses value? That's the next chapter. Chapter 2. Inflation, devaluation, and the illusion of wealth. Holding dollars might feel safe, but safety doesn't mean value, and value is what really matters. Let's rewind 20 years. $100 could fill your gas tank, cover groceries, and still leave enough for a movie night. Try that today. That same 100 barely covers one of those. The dollar has lost over 40% of its purchasing power since the year 2000. Not because of theft, but because of inflation. Inflation is a slow, silent leak in your wallet. It doesn't scream, it just erodes. You don't feel it every day, but when you compare decades, the loss is brutal. Now imagine you're a country holding billions in dollars. If you just sit on that cash, you're bleeding wealth. That's why they buy US bonds. Not because they're profitable, but because they lose value slower than cash. It's not about making money, it's about losing it slower. This is the strange logic of global finance. Buy bonds, you get a trickle of interest. But more importantly, you avoid total erosion. Now consider this. If you don't buy US bonds, what else can you do? Buy Brazilian bonds at 12% interest? Sounds good, until the Brazilian currency crashes. If that happens, you just lost 30% overnight. That's the trade-off. High yield comes with high risk. The dollar comes with low yield, but global trust. Even when the dollar weakens, it's still better than the alternatives. And that's why countries keep coming back. Even when they complain, even when they threaten to de-dollarize, they still buy more bonds. Because if they don't, their own currencies might spiral, and their economies might follow. That's the invisible pressure behind every central bank decision. Hold dollars and lose slowly, or chase returns and risk collapse. It's a no-win game. but the US plays it better than anyone. Now imagine what happens when the US intentionally lets the dollar fall in value. The debt it owes shrinks, the money it prints costs less, and the assets priced in dollars, stocks, real estate, commodities become cheaper for Americans but more expensive for the world. That's not a side effect, that's a strategy. While the world scrambles, the US prepares to buy back what others panic sell. That's the illusion of wealth. Your money might grow in number, but its power shrinks. Unless you're in control of the printer. And only one country is. So ask yourself this, is your money really growing, or is it just losing slower than everyone else's? Next, we look at how this game... Chapter 3, the Plaza Accord, Japan's fall and the blueprint of control in the 1980s. Japan was unstoppable. Its electronics dominated shelves. Its cars ruled the roads. Its economy was climbing fast. Too fast. So the US stepped in. In 1985, 5 powerful countries signed the Plaza Accord. The goal was simple: force the Japanese yen to rise, make Japanese goods more expensive, slow down Japan's export machine, and protect American industries. It worked. The yen doubled in value against the dollar. Overnight, Japanese products became too pricey for global buyers. A car that once cost $10,000 now cost $20,000. Sales collapsed. Factories closed. Jobs vanished. The economic miracle stalled, and Japan entered what's now called the lost decades. 30 years of slow growth, falling wages, stagnant progress, all triggered by a currency shift. That was no accident. It was a strategy. Raise their currency, then step in and buy their assets for cheap. That same tactic is being used again, but this time, the targets are global. Countries that rely on exports, China, South Korea, Germany, are now facing the same pressure: tariffs, currency games, sudden capital outflows. It's all part of the same playbook. The US doesn't need to invade, it just needs your currency to rise, and when it does, your goods become too expensive. No one buys, your factories slow, your economy cracks, your central bank panics. Then comes the final step. Sell off your reserves, buy back your currency, and hope it's not too late. But by then, damage is done. The US steps in, buys assets on the cheap, and resets the board. This isn't theory. It happened to Japan, and the world hasn't forgotten. That's why countries are nervous every time the dollar weakens or tariffs appear, because they know the pattern. And they've seen how it ends. Because the moment you try to resist, the pressure increases. Your exports decline, your savings erode, your currency swings, and panic begins. So what happens if you don't want to play the bond game? What if you try to escape? Chapter 4, the New Dollar War, Trade, Tariffs, and Traps. Tariffs used to be about protecting jobs. Now they're tools in a global money war. When the US imposes tariffs, it's not just blocking products, it's targeting your margins, it's forcing your prices higher, and it's weakening your position. Imagine you're a Japanese exporter. You sell goods to the US and earn $1 million. Suddenly, 30% of that is taken away as tariffs. Now you're left with $700,000. Then the yen strengthens. The dollars you earned now convert into fewer yen. That means your profit just shrank twice, not because your product changed, but because the rules did. This isn't a trade dispute. It's a financial trap. The goal isn't to stop trade, it's to shift power, make foreign goods more expensive, push Americans to buy local, crush the export advantage of rising economies. And if a country resists, the US has another weapon: currency pressure. That sounds good until exports collapse. Because when your goods cost more abroad, buyers walk away. Factories pause, unemployment rises, recession follows. It's the same outcome as a war, only without the bullets. So what can countries do? They try to weaken their currencies. They sell their own money. They buy US bonds. They reload on dollars. But that's exactly what the US wants. It's a strategy with two outcomes. If you buy US debt, America gets funded. If you don't, your economy takes the hit. Heads they win, tails you lose, and when fear spreads, something else happens. Investors sell foreign assets. They rush into the dollar. They call it a flight to safety. And just like that, the cycle repeats. Tariffs cause pain. Currency moves amplify it. Fear drives demand for US bonds. Then the dollar regains strength, and the game starts over. Every country sees it happening, but no one knows how to stop it. And when bonds and dollars feel like poison, some try to reach for the oldest lifeboat in Chapter 5, the gold trap. When even the exit is a setup, Gold is supposed to be safe. It doesn't rely on interest rates. It's not controlled by any central bank. It's held as insurance when things fall apart. But gold isn't as safe as people think, because even gold is vulnerable to manipulation. In 2008, when fear ruled the markets, central banks and investors rushed to gold. Its price soared. Then came the crash. Sudden reports flooded the news. Analysts warned of a gold bubble. Banks issued bearish forecasts. Wall Street began dumping gold, not slowly, aggressively. Thousands of tons were sold into the futures market, more than global annual production, all within minutes. The price collapsed, and panic spread. Investors ran from gold. They sold at a loss. They jumped back into dollars and US bonds. Exactly as planned. This wasn't just fear. It was strategy. Push gold up, trigger demand. Then crash the price and buy back in cheap. Meanwhile, gold becomes another lever in the same machine. And countries that bet heavily on gold, they lose both ways. First, they use dollars to buy it. Then the price drops. And now they hold less gold and fewer dollars. Their reserves shrink. Their buying power fades. Their currencies wobble. All while the US gains time and flexibility. It doesn't matter whether the world runs to bonds or gold. Both are priced in dollars, and both flow back to the same place. The game is set up so there is no safe exit. Not for nations. Not for investors. Not for anyone outside the circle. The passive path is about seeing these traps before you fall into them. Because even when gold shines, someone else controls the spotlight, and the switch, and the power behind it. But if gold and bonds are traps, what's left? Why does the dollar still hold power even when everyone's trying? Chapter 6. Why the dollar still dominates. The dollar is flawed. It inflates. It weakens. It's printed by the trillions. But it still wins. Why? Because there's nothing ready to replace it. Some say the euro could rise. Others point to the Chinese yuan. A few believe in cryptocurrencies, but none of them hold global trust. The euro is tied to too many countries. The yuan is tightly controlled. Crypto is too volatile, and trust isn't built overnight. It takes decades, wars, trade, treaties, and deep reserves. Every central bank on earth holds US dollars. Every major trade deal still settles in dollars. Every financial panic still leads back to dollars. Even when countries say they're de-dollarizing, their actions say otherwise. Saudi Arabia still sells oil in dollars. China still buys short-term US bonds. Europe still pegs currency moves to dollar flows, because no one wants to be caught without it. When Russia, $300 billion in dollar assets, gone. Without access to dollars, Russia's ruble collapsed. No one would trade, no one would sell, no one would buy. It didn't take sanctions. It just took one move, cut off the dollar. That's the level of control. Even enemies of the US still use its currency, because without it, they're locked out of the system. You can't buy oil. You can't import food. You can't pay debt. The dollar is the toll booth of the world, and the US owns the gate. Until another system is built, this won't change. Not next year. Not the year after. And while the world argues about replacing the dollar, it keeps buying more. That's the paradox. They hate it, but they need it. They resist it, but they hold it. Because losing access is worse than holding something that slowly leaks. And in times of crisis, slow loss feels better than sudden collapse. But what about regular people? What about you? What can you actually... Chapter 7. What regular people can actually do. You're not a government. You don't print money. You don't issue bonds. But you still play in the same system. And most people are playing blind. They save in cash that loses value. They invest long-term without flexibility. They react after the damage is done. You don't need more predictions. You need a better position. That's where your size becomes a strength. Big systems move slow. You don't have to. You can shift faster. Exit earlier. Enter sooner. When gold moves, you can buy in small and sell quick. When stocks drop, you can pick your spots. When currencies shake, you can hold what works now, not what used to. The passive path is about moving like water, not resisting every wave, but flowing around obstacles. You don't need to bet everything on one asset. You don't need to outguess the Fed. You need a system that adjusts with reality. Hold a mix of short-term safe assets and a few high-upside bets. Pay attention to what the big players are doing, but don't follow blindly. Use their moves as signals, not instructions. When central banks buy gold, ask why. When the Fed prints money, ask who benefits. When governments dump bonds, ask what they're afraid of. Most people ask these questions too late. By the time they react, the opportunity is gone. You need to think like the ones who see early. That doesn't mean being perfect. It means being prepared and flexible. You don't need to beat the system. You just need to not get crushed by it. That starts with awareness and ends with action, because the worst position isn't being poor. It's being passive in a game that punishes the slow. You can't afford to wait for permission. You move, you adjust, you protect. And when the system resets, you're not at zero. You're already one step ahead, but you still need a plan, one that fits your reality. Chapter 8. Building your financial game plan. You don't need to predict the future. You need to be ready for more than one outcome. That's how smart money plays. They build systems that survive shocks and thrive when others panic. Start simple. Split your money into 3 parts. Cash for immediate needs, liquid assets for fast moves, hard assets for long-term defense. Cash is your safety net. It doesn't grow, but it buys you time. Time to wait, time to think, time to act when others freeze. Liquid assets are your tools. Stocks, short-term bonds, high-yield accounts. They move fast. So should you. Hard assets are your shield. Gold, real estate, physical stores of value. They don't move quickly, but they hold strong when paper assets shake. You don't need to own everything. You need to understand what you own and why. Know what's likely to drop in a panic. Know what holds value when systems break. Know what gives you leverage when prices crash. Most people hold too long. They ride the wave up, then down, then they wait, hoping to recover. Hope is not a plan. Decide now. At what price will you exit? At what loss will you cut? At what gain will you lock in profit? Write it down. Stick to it. Markets are emotional. You shouldn't be. Your plan is your edge. It keeps you steady when the news turns loud, and it puts you ahead when the chaos clears. That's what the passive path is all about. Clarity, discipline, motion. You don't need to win every trade. You just need to avoid the big losses, because recovery from zero is slow. Avoiding zero is fast. If your country freezes assets, can you access value elsewhere? If your currency drops 30%, how does your portfolio respond? If inflation rises, does your income rise too? These are questions most never ask until it's too late. Don't be most people. Build your answers now, because when the next storm hits, and once you're ready, you'll start seeing the game for what it is. Not fair, not stable. Chapter 9. Don't wait for rescue. Move now. Every crash has winners. Not the loudest, not the smartest, just the readiest. The ones who watched quietly, who moved early, who didn't freeze. You don't need to be perfect. You need to be aware. The system wasn't built for your benefit, but you can still use it. Learn the signals. Follow the flows. Track where the money moves before the headlines catch up. Most people wait for news anchors to confirm what their wallet already knows. By then, it's too late. The dollar game won't stop for you. Tariffs won't pause for your job. Currency wars won't care about your savings. That's why you have to act now. Start with what you control. Build cash buffers. Simplify your expenses. Move a portion into liquid, flexible assets. Watch how gold behaves during stress. Watch what the Fed says and what they avoid saying. You don't need to mimic billionaires. You need to do what they can't. Move fast. Stay small. The passive path is not about doing nothing. It's about doing the right thing at the right time with the right amount, and then waiting for the wave. Let others chase hype. You position early. You wait for the flood. Then you let the system reward your patience. If you found value here, stay close to the passive path. Like, subscribe, comment with what you're doing to stay ready. Because in the next phase, things won't just shift, they'll break. And when that happens, only those with a clear plan will stand. Everyone else will be asking the wrong question. Why didn't anyone warn me? The game isn't fair, but you don't have to lose. You've seen how the dollar cycle works. You've seen how gold, bonds, and currencies get played. You've seen how the biggest players move before the headlines. Now you have a choice. You can wait and hope, or act and prepare. The passive path is here to help you think clearly, move smart, and stay ahead of the wave. If this video gave you something to think about, like it. If you want more content like this, subscribe. If you have thoughts or questions, leave a comment. And if you know someone who needs to hear this, share it with them. This journey is better when you're not walking it alone. Good luck out there. Stay sharp. And feel free to check out the other videos